Welcome to the Ullico Friday Fix. I'm Joe Lenahan, president of Ullico Investment Advisors, and today I'm happy to be joined by Tim Canine, Chief Investment Officer of Ullico's fixed income platform, UIA Investment Management. As we begin 2021, there is substantial uncertainty regarding the recovery from the pandemic and possible changes in government policy under a new administration. Today, we thought it might be helpful to spend a few minutes with Tim and hear his perspective on managing fixed income portfolios in this challenging environment. Tim, before we discuss market specifics, can you talk a bit about how you and your colleagues at UIA-IM think about portfolio construction and risk positioning?
Yeah, thanks, Joe. Our investment approach combines the benefits of sharing the best ideas of our investment committee with the responsiveness of having individual portfolio managers who are making decisions on a day-to-day basis. The investment committee will get together, we'll discuss the macro environment, macroeconomy, and we'll talk about how changes in the environment might affect the fixed income market overall. We'll also evaluate individual investment sectors, government bonds, mortgages, corporate bonds, et cetera, and focus on the return potential and the risks of each of those sectors. And then the output from this discussion is a set of investment themes that summarize the committee's views on positioning, including interest rate and yield curve positioning, sector overweights, underweights, and security selection opportunities within each of those sectors. And then the individual portfolio managers implement those themes as appropriate for each individual client, given those clients' unique return objectives and risk constraints.
Okay, thanks. If you were awarded a $100 million bond portfolio today, why don't you share with our viewers how you would position that portfolio?
Well, first we'd say thank you. But then setting up portfolios at this point, there's kind of four overriding macro issues that we're thinking about. One is equity valuations are near historical highs, and certain sectors seem really stretched in terms of valuations. Second is the timing of this pandemic recovery is still somewhat uncertain. We do expect to see substantial growth in GDP over the course of 2021, but that might be a second half of the year story, and the first quarter or even 2 quarters could be a little bit choppy. Third is US yields are low, but attractive from a global perspective. As you can see on the screen now, there's almost $18 trillion of non-US debt that are carrying negative yields. So, 1.1% 10-year doesn't sound that exciting, but it looks pretty attractive by comparison. And then finally, the Federal Reserve Purchase Program continues, and it's providing a big backstop for the fixed income market. So with that sort of backdrop in mind, we like the spread sectors, corporate credit being the most attractive sector for us right now. But we do recognize this recovery is going to be a bit uneven, and there are going to be certain issuers who are going to be winners, and there are certain issuers who are going to continue to struggle even as the economy comes back. Certainly, as we saw this past year, security selection is huge in the corporate bond market. You've got to be picking the right credits. So if we were investing in a new $100 million portfolio with all this in mind, we'd be overweight corporate credit with kind of heavyweights in communications and financials and less heavyweights in utilities and technology. But we would definitely be overweight corporate credit. And then within securitized markets, most of our focus is on agency mortgages that are buying what the Fed's buying, and then AAA rated commercial MBS.
Okay, all right. Well, when you're building these portfolios, are you making interest rate calls when positioning, the bonds in the different sectors?
Yeah, not to a significant degree. We view ourselves as fundamental value investors, so we spend our time and resources trying to identify sectors and specific securities that we think offer attractive value. We think that the kind of this focus on sector rotation and security selection provides a much more reliable risk-adjusted return than trying to make calls on which way interest rates move.
Okay. All right, so you're the CIO, but you're also the primary expert for mortgage-backed securities within the team. Share with our viewers some comments on the current environment for those securities and where do you see value?
Yeah, sure. So the agency mortgage market is now, approximately $7 trillion. So it's a massive market. It's one of the biggest markets in the U.S. fixed income. So it's an important part of what we're trying to do in delivering alpha. As Andy Stone mentioned in the last video that we did, there's been a number of recent developments that are kind of driving sector performance. And the biggest one of those is the Federal Reserve Asset Purchase Program. They now own more than $2 trillion worth of agency mortgages, and they're buying about 160 or $120 billion per month, some of which is just reinvesting paydowns. But they're at a huge footprint in the market, and that just continues to grow. So, we saw some underperformance in the agency mortgage market in the spring 2020, but we recovered very quickly on the Fed's purchase activity, which, as I mentioned, is continuing today. So we believe we've done a good job in our portfolios buying what the Fed is buying, but we've also found plenty of opportunities in sectors of the market where the Fed is not involved. So we perform detailed cash flow analysis that helps us better understand the risk and return characteristics of individual sectors and securities within the MBS market. And while we're at a time when mortgage prepayment rates are elevated just because rates are so low, we think the sector will do well relative to treasuries this year.
Okay. All right. Well, despite your youthful appearance, you've been managing fixed income portfolios for over 20 years, and you've witnessed a couple of severe dislocations and volatility events. How does the 2008-2009 financial crisis compare with the volatility and uncertainty created by the pandemic?
Yeah, so there certainly are some similarities and a lot of differences as well. The epicenter of the 2008 crisis was the mortgage market, of course. We had a huge bubble in housing prices, and the mortgage market basically created mortgages with the idea of making those expensive houses a little bit more affordable in the short run, but of course there was no regard for the longer term. Now currently we're in the midst of a public health crisis, and that's had a broader impact on the economy, and particularly a severe effect on service and the travel industries. So the two crises are similar in the sense that there is a huge required government response to mute a broader shock to financial markets. But we think the recovery from the current crisis will be much faster because we've seen a significant response both in terms of monetary and fiscal policy, as well as the development of a vaccine in just record time. So that's very different than coming out of a crisis with the financial system basically in tatters like we had in 2008.
Okay, understood. My final question is the same one that I asked your colleague Andy Stone. Interest rates are so low. Why should investors even own them, at this point in the cycle?
Yeah, well, probably no surprise to you, but my answer is probably going to be pretty similar to Andy's. But the role of fixed income in most institutional portfolios is to provide a safe, stable return with a pretty low correlation to some riskier assets like equities or real estate, what have you. As I mentioned, equity market valuations look pretty stretched at this point. So a fixed income portfolio can provide some shelter if we see an equity sell-off. Look, overall market yields are quite low, although, as I mentioned, they look better than most places in the world. But we also continue to find securities and sectors that offer attractive value for our clients.
Very good. Well, Tim, that concludes this episode of the Friday Fix. Hey, I want to thank you very much for participating with us today, and I want to thank our viewers out there that have tuned in as well. For more information, please visit us at ullico.com. Hey, thanks again, and appreciate everybody's participation. Have a good day.